What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone, brought to you by the Pulis Group. Today, we're going to talk about house hacking, which is a real estate strategy, and we'll talk about how it impacts your taxes when you do house hack. So let's start by defining house hacking. House hacking is it's simply a real estate investment strategy where you live in a property that you're also renting out. So this could be a house where you live in one of the rooms and rent out the other rooms, so in a single family home. Or this could be a multi-unit building where you live in one of the units and rent out the others. For example, maybe you live in a duplex, or you own a duplex, you live in one side and rent the other side out. So the idea is to have the rents cover your living costs, or as close to your living costs as possible, or possibly even get paid to live there. So it's said that most people spend around 30% of their take-home pay on housing. So eliminating that cost is huge when it comes to saving money for investment. A lot of younger people are finding it harder and harder to be able to afford to buy a home. So house hacking might provide the opportunity to make home ownership a reality for many people that are priced out of the market. House hacking also gives you practice getting in that investor mindset. So when you're looking at the cost from an investment perspective, rather than just your own personal budget, how much can I afford, it's going to help you develop those skills. So for example, you'll be thinking, this will cost me X. Can I rent the other rooms to cover X or some percentage of X? That's an investment mindset. So let's just take a quick look at how house hacking works. Let's say, for example, you buy a 4-unit complex. You live in one while renting out the other 3 units, and that rent from the 3 units covers your mortgage and the other operating costs. So your mortgage, insurance, you're living for free. This is a great way to start your real estate investment journey, especially if you live in a high-cost area. If you have the ability to house hack, sometimes this might be tough. That's why I say if you have the ability, if you have a family or a spouse that's really not on board, this may be difficult to accomplish. But if you have the ability to house hack and you're open to it, you now have money that would otherwise go towards your own housing costs that's freed up to invest elsewhere. Now, another example of house hacking would be if you own a single family home, you live in one of the rooms while renting out the others. Maybe you already own a home and you want to Airbnb a room or two in your house to help cover those living costs. It's bringing in additional money, help covering your own personal living costs. Now, this is a podcast about accounting and taxes, so let's talk about how this works from a tax perspective. So going back to our example of where you have a 4-unit place and live in one, your unit, that 25 is, let's say it's 25% of the total space, your unit is personal. Those are personal expenses. So you're going to allocate certain expenses, 25% to personal, 75% as rental expenses. So the other 3 units are rented out. Those expenses are rental. So your interest and real estate taxes will be allocated 25% personal. So if you itemize on your individual return, those will go on Schedule A. If you use the standard deduction, there's no deduction for the personal portion of your interest in real estate taxes. The other 75% of interest in real estate taxes will be picked up on Schedule E to reduce the rental income. And what about insurance? So there's no deduction for insurance on your home from a personal perspective. However, when it comes to a rental, insurance is a deductible expense. So you would take 75% of the insurance cost and report that on Schedule E as another deduction. And then we have things like repairs and maintenance. So repairs and maintenance to the common area would be allocated 25% as a personal cost, 75% is a rental expense. Repair and maintenance to your specific unit would be personal and not deductible. Repairs and maintenance to the rental units would be 100% deductible, or possibly maybe there are expenses that need to be capitalized, so they'd be capitalized and depreciated. If it's an expense that needs to be capitalized for your personal unit, you can add that to your cost basis for when you sell the home later, which takes us into what happens when you sell. So when you sell the building, now we were talking about the fourplex here in our example, you're going to again split those gains 25% personal, 75% to rental. Well, the personal portion will qualify for the Section 121 exclusion. Remember, that allows you to exclude up to $250,000 of gain from the sale of a primary residence if you pass the ownership and use test. So you have to own it for at least 2 years and use it for at least 2 of the last 5 years as your personal residence to qualify. If you're married, that exclusion is $500,000. So the 1/4 is eligible for the Section 121 exclusion. The other 75% is not, because that's a rental property. That's not eligible for the exclusion. So you're going to pay tax on the gain. You'll pay tax on the depreciation recapture. So remember, you're depreciating those units. Depreciation is factored into the gain calculation, whether you take the deduction or not, because if it's allowed or allowable, then that adjusts your basis. You want to make sure you're taking the deduction. However, that rental portion, that 75%, is eligible to use in a Section 1031 exchange. So you can use Section 1031 to defer the gain and depreciation recapture on that rental portion, the 75%. Use the Section 121 exclusion for your primary residence on the other 25%, and defer what you exclude the gains on the personal portion, defer on the 1031. So with proper tax planning, you could really make this work out to your advantage. So to summarize, house hacking is a real estate investment strategy that allows you to cover part or all of your own housing costs by renting out the home that you live in. It also gets you in that investor mindset. Then from a tax perspective, you allocate expenses between the personal and the rental portions. And when you sell, you can use the primary residence exclusion under Section 121 on the personal portion, assuming you meet all the tests. And you can use a Section 1031 exchange for the rental portion. Again, you're going to have to pass all the standard tests to qualify as a section to defer the tax under a 1031 exchange. But again, this is where proper planning comes into play. So that about does it for today in our discussion on house hacking. Hopefully this provided some value. If so, please leave a 5-star review and hit the like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.